Have you ever wondered how central banks manage something as complex as a nation's money supply and interest rates without directly dictating what commercial banks should do? It is a bit like steering a giant ship not with a direct rudder, but by influencing the currents around it. Central banks define open market operations, or OMO, as the buying and selling of government securities in the open market to expand or contract the amount of money in the banking system. It is their primary and most flexible tool for implementing monetary policy. The core mechanism behind OMO is its direct impact on commercial banks' reserves. When the central bank buys government securities from commercial banks, it pays for them by crediting the selling bank's reserve accounts. This increases the total amount of reserves in the banking system. With more reserves, banks have more money to lend, which tends to push down short-term interest rates. Conversely, when the central bank sells government securities, commercial banks pay for them by drawing down their reserve balances. This reduces the total amount of reserves, making money scarcer, and driving up short-term interest rates. This indirect method allows the central bank to influence the overall cost of borrowing across the economy without directly setting individual lending rates for consumers or businesses. Understanding OMO involves recognizing two main types of transactions: outright purchases and sales, and repurchase agreements or reverse repurchase agreements. Outright transactions involve a permanent change in the money supply, with the central bank buying or selling securities with no agreement to reverse the transaction. Repurchase agreements, known as repos, are short-term agreements where the central bank buys securities from banks with an agreement to sell them back at a specific future date, acting like a temporary loan. Reverse repos are the opposite, where the central bank sells securities and agrees to buy them back. These temporary operations are crucial for fine-tuning liquidity on a daily basis. A key concept here is the federal funds rate in the United States, which is the target interest rate that the Federal Reserve aims to influence through OMO. This rate represents the interest rate at which commercial banks lend their excess reserves to other banks overnight. By altering the supply of reserves through OMO, the central bank directly impacts this overnight rate, which then cascades throughout the financial system, influencing other interest rates for consumers and businesses. So, whether you are trying to grasp the nuances of monetary policy or simply understand how economists think about influencing financial markets, recognizing OMO as the central bank's most adaptable instrument for managing bank reserves and steering short-term interest rates is fundamental. This process helps maintain price stability and support sustainable economic growth, all by carefully orchestrating the buying and selling of government bonds.